Hi guys, and thanks for joining in. Do a quick sound check to make sure you guys can see the title screen okay. Great, good stuff guys. Okay, welcome to day 2 of the One seminar. Hope you guys enjoyed yesterday and found it useful. There was lots to take in. Just to reiterate that, do take on board what was taught and understand that you need to apply those concepts creatively. There is not only one way to apply these concepts. There are many different ways, and you will find your own way. And that's what I encourage. I encourage creativity. And please do make it your own. It's very important as traders to make the style of trading your own. So do use what I teach you from what I do and how I trade as a guideline, but use it just as that, as a guideline. Each and every single trade is different. Each and every single day is different. But however, the markets do have a structure. They do move in an organized manner, as we can see from the auction market theory principles. And the markets are either balanced or they are imbalanced. And if you can at least start each and every single day and each and every single trade with one question, asking yourself, firstly, is the market balanced or imbalanced? You have a very good chance of trading in the right way for that situation. So do understand if the markets are balanced. Most of the time they are. Understand if there is value. Understand where that value area may be perceived to be. Not necessarily just a day's value area. It could be an area of value that has been in place for the last 2 days, 3 days, 1 week, 2 weeks, the last month. We see this all the time. As long as the market is rotating sideways around that range, it's a balanced market. I gave you some examples yesterday. And again, that is fractal, meaning that it applies to every time frame. You can see that on a 5-minute chart. You'll see that on a 10,000 volume chart. You'll see that on tick charts. You'll see that on Renko and range bar charts. You'll see that on daily charts, weekly charts, monthly charts. So it's irrelevant on what time frame it is. You will see the same structure. So whatever time frame you decide to trade, understand what context you are trading within. Is the market balanced or is it imbalanced? That way you can decide whether you should be going with the market and its directional conviction, if there is any. And understand in the situations when there is no directional conviction and the market is balanced, you can therefore understand when you should be looking to fade the market and any attempts to move away from that area of value or that range that we are currently trading within. So anytime we see these extensions outside of the range, we can find some key levels. As I shared yesterday, the low volume areas are essential to look out for. The Fibonacci extensions work extremely well in those situations. I also showed you how to apply the volume profiling concepts in trending imbalance markets, looking for pullbacks or bounces to those areas for doing business. So yesterday was very much about understanding the market structure, understanding whether the markets are balanced or imbalanced, understanding what the auction market theory principles are, understanding the purpose of the market is to facilitate trade, and hence the reason why we find the market always returning back to balance and spending most of its time balanced. So if you are to focus on anything, I would recommend personally trading balanced markets, looking for balanced markets, clearly balanced, that you can trade around and look to fade back into that area of balance, that area of acceptance. When the markets are clearly trending, you can either make the choice to adapt and go with it, or sit on your hands and just wait for the next area of balance to form. So not really that complicated, very much simplified. And what I've done over the everything that I've learned over the last few years, I've very much simplified it and made it much easier to understand over this seminar. So if anybody finds it is a little bit too simple, that's a good thing. Okay, trading doesn't need to be complicated. Trading is actually quite simple, but it doesn't mean it's easy. So the best thing to do is simplify your trading. Have a simple way to approach the market. Understand it really well and become creative with your understanding. Be able to apply what you understand in the moment. Be able to adapt in the moment. Right, today I will be moving on to step 4 of the Auto-SD game plan, which is trade execution and timing. So I will be covering some more tools to help you do that job better. We will look at the depth of market, how I read the depth of market, talk a little bit about how things have changed on the dome, but very much you can still see the patterns, and I'll give you some examples today. The time and sales, which is basically the data that we use to formulate the footprints. I'll discuss that, and then we'll move over to the footprints and discuss how I use the footprints, and maybe you can gain some insights of how you can put the footprints to use in your own trading as well to help you with timing and execution. The thing when you're getting into a trade, it's about understanding that what you thought may happen from understanding the auction market theory principles and the structure that you've been reading, using everything that was taught yesterday. You then have to know when to get into the market, when to actually pull the trigger. And trade execution is all about that, understanding when to pull the trigger. And the market generated information can give us some great insights into when that is a good idea. I'll then move on to trade management, how you can manage your trades in a number of different ways. And of course, it again comes down to your own financial situation, your own business plan, your own objectives and goals. Each and every single one of us will be trading different position sizes. I'll go through different trade management techniques, discussing the benefits of each, as well as the disadvantages of some. But the ones that I will share with you today pretty much all have their pros and cons. So we'll discuss that, and then we'll move on to how to move forward. How do you begin to apply this all? How do you develop some daily routines to stay disciplined? And then we'll finish off the end of the day by giving you some practical steps that you can take on board, some of the tools that I use to help keep me disciplined and help keep me focused and fully engaged in my trading. So hopefully that sounds good, guys. And without further ado, we'll get started. Quickly read through the disclaimer. Auto-SD does not have any knowledge of the trading needs or objectives of individual viewers of this presentation. This presentation represents suggestions, training and information for viewers to use when evaluating and making trading decisions in light of their own individual trading goals, and does not constitute specific advice. Auto-SD does not take into account the trading objectives, financial situation and needs of any particular person. And before making a trading decision on the basis of an Auto-SD method of trading, the prospective trader needs to consider, with or without the assistance of an advisor, whether the advice is appropriate in light of their own particular trading needs, objectives and financial circumstances. Trading the futures market involves risk. Money can be both lost and made. Okay, let's move straight into trade execution. As we've just discussed, it's all about timing. It's about finding the entry into a trade. However, with risk management in mind. Through a good entry with good trade location, you can actually limit your risk. A poor entry can increase your risk. So the time you decide to get into a trade does make a difference to the amount of risk that you may have to potentially take in that trade. So trade execution is itself also a risk management tool. However, I must say, by looking to execute in a manner where you are looking at better trade location with risk management in mind, do not look to be perfect. It's not about being perfect. Trading is all about embracing your imperfections and allowing for them with good risk management. So through your trade execution and your trade execution techniques and some of the techniques that I will share with you today, you will allow for your imperfections, especially when it comes to the trade management part. So don't worry too much about, am I getting in exactly at the right time before this market moves? Yes, you will increase your chances of that happening, but not every single trade will lead to a perfect entry and perfect timing, perfect execution. Okay, you may well get better at execution for the tools that I will discuss and the techniques that I will discuss. But one thing that you will have to understand is that you'll never be perfect at execution. Okay, I've had to understand that myself. As much as you may seek perfection in your trading, you can't be 100% perfect. I will still take trades where my timing is a little bit off. I deal with that imperfection through risk management and trade management. Okay, so it's very important to understand when it comes to execution, you're not looking to be perfect. It's not about getting the exact right time where this market is about to move. Now, you may be able to do that under many situations. And a lot of the time, I'd say probably 80% of my trades, I do end up being able to achieve very good trade execution where the market pretty much moves in my direction after getting in. However, I understand that's not going to happen all the time. And sometimes I get into the trade with a smaller position, actually, contrary to what some traders may think, actually hoping that the market will move against me. Because then I can add into the position and build my position at better prices, which I'll talk about more so in the trade management section today. So don't worry about being perfect with your entries. It's not required. However, do understand that good entries do help limit risk. So it is worthwhile taking the time to find a good entry with good trade location. Everything that I discussed yesterday about auction market 3 principles and market participants' behaviors, unfair highs, retail prices, unfair lows, wholesale and premium, as we discussed yesterday, that will come into play also when it comes to trade execution, as you will see, on more of a micro level. Balance and imbalance is also evident when it comes to reading order flow. So this is why it's essential for you to have understood yesterday very well and understood balance and imbalance and understood the auction market 3 principles, because you need to understand them on a micro level for execution as well. So we will use market structure for trade location and also to limit risk, and you'll see some examples of how you may be able to do that. Okay, and that's this leads to being a bit more patient and waiting for the right entries and the right times to get in. Now, the other thing when it comes to trade execution is that you have to understand a lot of this is market feel. Many of you have probably heard that trading, a lot of it is an art form, and I've discussed this many times in my previous seminars and webinars, and I talk about this all the time in the room, and I very much will discuss what I'm feeling about the market rather than seeing. And the reason is because sometimes the way you trade is based upon feel and how well you understand and are in tune with that market. I'll discuss some of the ways to get in tune with the market later on today. So developing a market feel is essential. You can read price action to do that and order flow. I use a combination of what price is doing and order flow at price. This is what helps me time the trades and helps me get into trades with good trade location most of the time, but not 100% of the time. So it's very important to understand price action is a big part of execution. Although I use order flow tools, you have to understand the basics of price action. When price is trying to move higher, when it looks like it's rejecting, you have to understand the basics of when price is trying to move lower and when it might be rejecting before you start to apply order flow for timing. Now, the reason I stress this is because in previous seminars, webinars, traders, I feel, have become a little bit confused with the concept of order flow. And maybe I didn't make it clear enough that price action is an important concept, and you use order flow to confirm what you are anticipating price to do next, or you use order flow to confirm what you feel price is doing. It is important to understand that, because if you're just looking at order flow, it can be a little bit misleading. So you have to use price action and order flow together. Okay, really important. Okay, everyone following me so far? Good stuff. Now, trade location is really important also when it comes to timing and execution. Like I said, you have to apply the auction market theory principles on a more micro level. Understanding what might be the unfair highs and lows of where the price is testing right now. What is premium? What is wholesale? What is retail? Where are the fair prices right now? Is the market balancing? Is it imbalance? You'll see how you can apply these concepts on a micro level as well. When you're reading the dome, when you're reading the footprints, as well as when you're reading price action from a micro perspective. So, let's firstly look at price action. We'll look at some examples of when price rejection is occurring and acceptance is occurring. Again, the concepts of acceptance and rejection, but reading it through price action rather than volume. We use topping and bottoming tails to identify rejection. We use bar initiations and closes to define acceptance and imbalance occurring. I'm going to move over to some charts, look at some bar chart examples, some candlestick examples, and then Heikin Ashi bar examples. Okay, so this is a basic 15-minute chart, which I feel is a good time frame, which is somewhere in the middle. It's not too much of a larger time frame. It's great for day trading, and it's what I use right next to my trading platforms to help with execution. So now I use a separate trading platform, a separate PC for actual execution. The way I'm set up is I have a VPN connection to my prop firm. And I dial up to my prop firm and I connect, then I get access to my trading platform and the exchanges via my trading platform, which is Trading Technologies Xtrader, which you'll see some examples of today with some of the video clips that I have to share. So let's look at some of the examples here. Let's do simple bar charts firstly. Let's just take all of this off here. Maybe we'll look at just LVNs and HVNs. So applying the basic concept of acceptance rejection of these levels. And just notice that some of these low volume areas where we might have seen rejection from just looking at price action. And remember, this is going to be building in real time, and you'll be able to see the rejection occurring. I often cover this in the trading room, and one of the simplest ways to read rejection, as and when it's occurring, is to use a bar chart or a candlestick chart. Now, some of you guys are, I would assume all of you guys are very familiar with candlesticks and bar charts. Is that right? Is anybody not familiar with candlesticks and bar charts? I'll be very surprised if if anybody doesn't know what a bar chart or a candlestick is. But some of you might be more familiar with bar charts than candlesticks, or some of you might be more familiar with candlesticks and bar charts. Okay, so use open, high, low, close. So yeah, again, it's personal preference. I personally prefer candlesticks because I can see the rejection more clearly. Because I like to see topping tails and bottoming tails, and then I use order flow to confirm that. You'll see that. And if you start to apply that basic concept for timing, you'll be surprised at how effective it is. The thing is, you have to throw away this concept that certain things don't work. Okay, and it's really important that you sometimes go back to the basics. It doesn't matter how long you've been trading, because a lot of the time we will find, if we open our minds and we empty our cups, that things that we've used in the past do actually work. However, we've been led to believe that they don't work. Maybe because through past experiences, we've not been able to trade effectively with them. That doesn't mean they don't work. That means you didn't work when you try to use it. Okay? And then also, you'll hear other traders say, okay, this is no good, that doesn't work. Okay? You got to throw away those concepts and ideas that things don't work. Everything actually works. I say this in the trade room all the time. Moving averages work. I use moving averages as well. Okay, I use a 34 and an 89 exponential moving average. In a trending market, you put that on any time frame, on any market. Without a doubt, you can see when the market's trending, and a lot of the time we will pull back to these moving averages and continue the trend. So people will say moving averages don't work. Stochastics doesn't work. MACD doesn't work. When the truth is really, people don't know how to make it work for them. Okay? As harsh as it may seem, that's actually the reality of it. Because there are people that are using moving averages effectively. There are people that are using candlesticks and bar charts effectively. There are people that are using stochastics and MACDs effectively. But just because you personally wasn't able to use it effectively doesn't make it not work. Right? Everybody agree? So we've got to just get that out of the way firstly. Okay? So open your mind and do understand that things do work. Okay? So when you understand the market really well and you can apply the concepts that I'm teaching over these next 2 days, it may take you a little while to understand it fully. But you'll agree at some point with, yes, everything works. Because now I can see past it. I can actually see what the market is doing. Irrelevant of what indicators I've got put on the chart. Okay? Because whether I put moving averages on here or stochastics, I can see what price is doing. I can still see where price is balanced or imbalanced. I can still see where rejection is occurring, irrelevant of what I put on the chart. Okay, so everything works. Okay, I'm not going to cover moving averages now, but I do use moving averages, and I will put them on the charts in trending phases like this, and I will look at a 3489 exponential moving average for directional conviction. So something that I didn't cover in detail yesterday, but do take that on board, and without a doubt, you can see that's pretty much highlighting that push down, and we are getting pushes back into those moving averages and holding them as resistance and pushing back down, and when we get back above them, we are pulling back to those areas and holding them as support. You combine that with some of the acceptance rejection concepts using volume profiling, and you time your trades and manage them well, it definitely works. A lot of it comes down to trade execution, timing, and trade management. And because some traders find it difficult to time trades well, or are not quite sure how to manage them well, or just don't end up managing them well, they blame the tools that they use. Bad mistake. Never blame your tools. They are just tools. They are decision support tools. It's down to you as the traders to know how to use them well. Okay. Now we've got that out of the way. Let's have a look at some bar charts. So bar charts. Now, I prefer, if I'm looking at a bar chart, I would prefer to have it all the same color. I'm not interested whether it's red or white or whatever color it might be. The colors will just define whether they open lower and closed higher. Now, if you look at some of your bar charts, especially on a longer time frame perspective, you will see these spikes and bottoming and topping formations. Get a very simple concept, but you've got to be able to read price, not necessarily bar charts, but at least some kind of price action chart. You need to be looking at some kind of price action chart before you start looking at confirming with order flow. It's not absolutely essential, but I feel that you will feel the market better if you understand what is happening from using a combination of price and order flow. Okay, so some of the time, what we see is these topping towers, these wicks. Sometimes a little bit more evident than other times, but you'll see the market will sort of trade lower, spike into an area of rejection like this, and then close up. Okay, so what happens is basically the bar opens, trades lower, trades higher, closes up. Okay, now that itself means that this was rejected. So whenever we see the wicks of candlesticks, of bar charts, that is a sign of rejection. Very simple concept, but very effective. Okay, you don't need to know. Candlestick patterns as such. You don't need to know whether it's a Heiken, a Doji, or a morning star or whatever formations, it's not important to know. All you are looking for is rejection and then acceptance. Okay, so on a simple bar chart, you'll see rejection with a spike down like this and then close higher, that's acceptance of higher prices, and then continuation of higher closes is acceptance of higher prices. Very simple concept. We see some of the other classic formations, double tops, important to consider, head and shoulders, etc. Chart patterns. You see a head and shoulder formation like this. They're important to consider. Now, I'm not going to go to chart patterns. It's some basic stuff, but you might want to do some background research on chart patterns. Actually, there's a nice website, chartpatterns.com, which covers some basic chart patterns, which you might use to confirm potentially topping price patterns, potentially bottoming price patterns, and then you use order flow to confirm that. Okay. So on bar charts, we'll see these little spikes. Of course, you can see when the price actually makes a bottom and starts turning around as well. You can see when it trades lower and actually starts closing higher and then starts trading higher. Not a very difficult concept to understand. Now, if you're a little bit more aggressive with your entries like me, you'll probably be buying into the bottoming tails and selling into the topping tails. Now, bar charts is a little bit more difficult to see that. So this is why I'm going to move over to the candlesticks, where it'll be a little bit more evident, a little bit more clearer to see bottoming and topping tails. And this is really the only thing you need to understand about price action when it's occurring. On any time frame really, but I like 15-minute, 5-minute charts so that you don't become too aggressive and you can actually wait for the market to trade a little bit at an area before you decide to start trading into it with the order flow. We see a big spike up here that was on the number on Friday, and then we saw a rotation back down. Okay, I was actually selling into that. Okay, so when that rejection started to hold up there, I was selling into that. Notice where it occurred, this red line, low volume area right here. Okay, so we spiked up on the numbers, had a bit of an overreaction to the numbers, and then we had a rotation back down. Notice what happened when we had the rotation back down. We then had rejection lower as well. The market doesn't just turn. Often you find it's okay to wait for that 15-minute bracket to stop trading and the next bracket to start trading before you start getting involved. And actually, if you're new to order flow, it's probably advisable that you wait for that to happen before you start looking for the order flow confirmation for execution. Because one of the issues that I find from working with traders that I commonly see an issue for traders is when they start to use order flow, they become too aggressive. They start trying to pick tops and bottoms too aggressively, and often see themselves, mistiming the trades because they're too eager to get in. So there is no special prize for being early. There is no special prize from the market. The market doesn't give you any special recognition for being first. Okay, there is no gold medals for being first in trading, right? So there is this thing in the human psyche where we feel that we have to get in just in case we miss out. Okay, it's the fear of missing out playing out, that is. Okay, trying to get in just in case. Now, don't get me wrong. There are times where you will just know, okay, this is the time to get in, and you're getting a little bit more aggressively. Now, I even do that, okay? Like I said, with timing, when it comes to trade execution, you don't have to be perfect. You can't be perfect. Sometimes you will be early, but you deal with being early through trade management. If you feel that you might be early, you don't go in with a full position. You go in with a quarter position. You go in with half a position. So if the market still moves against you, you can scale in and improve your entry price. Okay, now do understand when I get into this later on, and I'm talking about this right now, that it's not scaling in, averaging in, or averaging down on a trade. Okay. Now that's probably something that you will do more so when you start to trade multiple lots and start trading bigger. When you start trading bigger, it becomes an essential part of your trading. On most markets, if you're going to use limit orders for entry like I do, that you start to scale in your trades because it's just easier to get filled. Some of you guys might know that as iceberging, or that's when you build or go into a trade. Usually, iceberging is going into a trade at the same price but in smaller chunks. So it's not quite the same, but a similar kind of concept. It's like scaling into position, okay, but not necessarily at the same prices. So, okay, coming back to the candlesticks, very simple acceptance, rejection, topping tails, bottoming tails. Of course, your standard topping formation, doujis, etc., are important to read, and spinning tops, but they themselves are quite often misleading. You can see here the market was making small, what some would consider reversal candlesticks all the way up. The market didn't reverse. So if they are confirmed with a bottoming tail or a topping tail, and this is why the gravestone doujis and those douji formations with the spikes at the top and spikes at the bottom, those are nice topping and bottoming formations. Okay, so you don't need to know the names, etc. If anybody's confused by the naming conventions of candlesticks, I mean, just Google candlesticks, you'll see them all. If you want to know the names are not important. Okay, what's important is, okay, what is price actually doing at my area where I expect rejection to be? If it's just getting to an area of rejection, like here, when we get into this area, this is the heads up right here. Okay, we spiked up, we pushed down, okay, and then we couldn't take out that area of rejection. So the most important thing to do is to notice what happens after that area of rejection is put in with price. So these are 15-minute bars, like I said. So this 15-minute bar closes. Notice what happens when we keep retesting that area that we spiked into. We can't get into it, and we keep rejecting with topping tails into that area. Can everybody see that? I mean, this is just recent example. That's why I'm using this. But it's a very simple concept, but it's so effective. Now, of course, you're not going to just trade off that. You could and do very well with it. But, order flow will help give you the confidence to pull the triggers when you see that happening. And not only see that happening, but you can also actually see that order flow is confirming what you feel that you might be seeing. Order flow is confirming that price is rejecting up there. And we don't want to trade it any higher. Does everybody see this? I'm not getting much feedback today, guys. I'm either not coming across effectively here, or you guys just don't want to get engaged. You see it, right? Maybe it's too simple for some, but forget about that. You don't know anything yet. Remember, okay? You're a sponge. You're sucking this in, okay? Nobody said trading has to be difficult when it comes to the technical side of things. This is simple stuff. Most of you guys know this. But if you don't know how to use it effectively yet, that's an issue. So you need to know how to use it effectively and apply it effectively in your trading. Because it works. I use it all the time. I know other traders that use it all the time. Trading doesn't have to be complicated to be effective. This is simple stuff. Kindergarten stuff. But if you are a good trader, you should be able to trade these simple concepts effectively. Okay, so basic concept of rejection occurring. Again, we had it here. I mean, you can see this playing off on a slightly smaller time frame. Right here. Now, I use Renko charts for Heikin Ashi, and this will bring me onto my next topic of Heikin Ashi bars. Good stuff, James. I'm glad you agree. And every single one of you have to agree at some point. Otherwise, you will find it difficult to trade this way. You have to agree that this should be simple. Shouldn't be complicated. Because if it's not simple, you won't be able to trade it. It needs to be simple for you to understand. And you need to go away and actually be able to execute trades and manage trades effectively based upon some simple logic. Do I take custom profiles on those 15-minute charts as well? Well, it's not time frame specific. I'm just happen to be looking at a 15-minute chart right there. But yeah, I'm usually looking at 30-minute, 60-minute charts. But I will use multiple time frames. I'm not looking at time frame as, okay, I'm going to use a 5-minute, 15-minute chart. If you're going to use time frames the way that I use it, time frames are very much to be used as zooming facilities. It's irrelevant of what time frame you use. The concept is the same. The question you've got to ask yourself, does what I see on that time frame help me to reach my objectives? Oh, the concept of rejection. Yes. When it comes to rejection for timing, I'm looking at this on generally my 30-minute, 60-minute charts, which is normally my longer time frame charts. Yeah, sorry about that, Ben. So yeah, I'm looking at my for when it comes to timing and execution. I'm reading this with the candlesticks. On my trading platform, I normally have a 5 or a 15-minute chart, but it does depend on what I feel I should be looking at in that moment. Because if I feel it's quite a tight range, and I'm looking at let's just use an example here. Now, I might be looking at these ranges here, and if I'm planning to trade within this range, I probably won't look at a 15-minute chart. I will probably be looking at, something like a 2-minute. But if I'm trading around my bigger time frame, which in this case, I've got a 120-minute chart. So if I'm looking at trading around this rejection area up here on a 120-minute chart, that's my setup chart. Now my execution chart around that area will be about a 5 or a 15-minute time frame. Okay, I like 15-minute because it's not too aggressive. So because this is such a wide time frame for the setup, the 120-minute chart, it would make sense for me to use a 15-minute chart because that's such a wide range. I don't want to be too aggressive, and I do want to let it trade up here a little bit before I start deciding to get short. Okay, and it's important to understand that these moves, these bigger moves, don't just turn. The market will trade there for a while. Okay, I mean, we've been seeing a lot of the time. I mean, this started to set up at 4 p.m. It didn't actually move until the evening around 8 p.m. Okay, GMT. So these moves can take some time. So now, but if you're looking at a smaller time frame setup, let's move to say. So it does depend on the range you're trading around. So there's a setup chart, which is my wider time frame, my bigger time frame. That's the way that I look at it. And then I have an execution chart. Now, this, I'm trying to find a smaller range. We've had some quite wide ranges recently. All right, now, what is this, the 7th? So we had a bit of a range up here. Just trying to find maybe a smaller range of consolidation. Sideways range. Yeah, I mean, here we had a slightly smaller range of consolidation. Let's say, your perception of market participants' value is this range right here, and we're trading around this on a 30-minute chart, which is what I have been pretty much using most of the time. But the market conditions change, the ranges extend, they widen up, and they get smaller at times as well. So as the ranges get wider, you move to a bigger time frame. As the ranges get smaller, you use a slightly smaller time frame, right? So I'm normally using a 30-minute chart up to about a 120-minute chart for setups and opportunities. Does that make sense? And then I am using either a 5-minute, 15-minute chart to help with timing and execution. Now, I do use Renko charts as well, which I'm going to move on to next with the Heikin Ashi bars. Okay, but you don't have to use all of those charts. Now, I use a longer time frame chart for setups between a 30-minute to 120-minute chart setup. That's my context. That's what the context that I trade within. Okay, I trade those setups because they are likely to give me bigger moves, and I'm more likely to bring in longer time frame players. Which, remember, if we go back to day one, we want to trade with the institutions. We want to be the flies in the back of the elephants. Okay, so that's how you do that. You use a 30-minute, 60-minute, 120-minute chart, and don't get too tied up with the short-term stuff. And you trade those setups, but execute using smaller time frames to read rejection and order flow. Okay, does everybody understand that? Okay, do use a wider time frame for setups, a longer time frame for setups, and identify the opportunities, but then use a smaller time frame for the execution to help read the execution. To help read price action on a micro perspective to help with execution. So now let's say I want to trade around this range, which is a lot smaller. Now this is 44s up to around, it's about 45s down around 37. It's a smaller range. So in something like that, it's still okay to use a 15-minute chart, but you probably want to drop down. When was this? Just trying to get to that time. There we are. So in this area, again, time frame is very much a personal thing. These are the time frames that I like to watch next to my trading platform. And in very small ranges, there have been times where I'll even drop down to a 2 to 3 minute. But most of the time, the kind of opportunities that I'm looking for, I'm using a 5 minute or a 15-minute. That prevents me from getting just too aggressive as well. So that's 15-minute. I have to move that to 5-minute. So now, if I zoom into this, so there's basically, it's the same range, right? But you can still see the rejection on the 30-minute chart. It's not that you can't see it. You can see it. Do I use similar time frames on the DAX? Well, I don't actually trade the DAX anymore because it's been a little bit too volatile, and I've been trading more so the Bund and the Euro stocks since August. Well, the Euro stocks pretty much up until January, and mostly the Euro Bund. So, but yes, so it's basically the same time frames on every market. I use between a 30-minute to 120-minute time frame for setups and structure, and then I use a 5 to 15-minute chart for rejection. So yeah, I mean, it's pretty much universal on all markets. Okay, so if I can finally zoom into this, so we can see this in a little bit more detail. Here we are. I mean, that's enough. We've zoomed in enough there. So, you can see here on a 5-minute chart, very much the same kind of thing. It's these areas of rejection we're looking for really stand out. And of course, it have to be an area where we want to do business as well. So you're not going to just trade every single price rejection or topping bottoming tail. I suppose those are the traders that say it doesn't work when, they take them here, there, and everywhere with no real understanding or context. The thing is, you've got to remember, understanding where to do business and understanding where market participants are likely to cut off the market and cause a reversal is an important part. You've got a huge edge just from understanding that and looking at the time you're trading in an area which is of interest to longer time frame players. Right, so we can see it there on a 5-minute chart. You can see these, we start to bottom out. Okay, you see these wicks. You can see that also then confirmed on the 30-minute spike here. So yeah, 5-minute chart, even for that range, may be a little bit too small. Okay, I would recommend most traders use about a 15-minute chart. Now that might mean you miss some of the smaller moves and some of the moves where the market moves really quickly. Okay, but very rarely will you miss the best trades. Okay, and I've been finding the 15-minute chart pretty much good enough for anything. When you just want to confirm some rejection. Now that is being a little bit more conservative. Of course, when we move to the Heikin Ashi charts and we start covering the Renko bars, which I'm going to cover, you'll see stuff happening a little bit more quickly as well. So you can use those as well. But, you can see this. You can see these topping formations, confirming with the 30-minute chart. It's very much confirming the same picture, but a little bit more rapidly because we're seeing bars opening and closing more quickly. But, 15-minute chart gives a good picture, I feel. And again, don't want to confuse it too much. It's the concept of rejection. You'll see it happening in real time. You'll see the market will test up, reject, and then the important thing to do is retest an area of rejection. Okay, so you don't want to just see a spike like this, an area of rejection, a wick. You want to see it test and see what happens once we retest it. Okay, and this is where the order flow really comes in handy. So you use that as a heads up on price action, and then you don't just get in when you see that. Okay, you use that as a heads up. Okay, we might be getting some rejection here. Price is starting to show me some rejection in a key area. Let me see if we are actually seeing some rejection on order flow. So remember, you can't see inside the bar by looking at a price action chart. Now, this is where the footprints come in really handy, and reading the dome and also reading the time and sales, because you can actually see what's actually happening. You can actually see the rejection happening in real time. You can actually see the orders struggling to take the bids out when we're bottoming out. You can see the buyers then start to lift the offer to confirm that rejection. You see something like this at the highs. That's just a heads up. We might have some rejection. Then you can watch the order flow and say, okay, are we struggling to lift the offers? Coming in at 43s, 44s. Are we starting to see some sellers aggressively start to hit the bids here, coming off this rejection? Does that make sense? So you're not going to just blindly use this. You can, and it's a good way to start, but if you plan to use the order flow, you want to use it in conjunction with this, in reference to some rejection on price. Now, you can also see rejection on Heikin Ashi bars. And that's often what I'm looking at as well in the trading room. Okay, but I like to have just a minute-based chart right next to my trading platform. Now, my trading platform doesn't support Heikin Ashi bars. I use Xtrader. I use Xstudy charts. It doesn't support those kinds of charts anyway, but you don't need that. When it comes to execution, you're just looking for timing. You just want to see what price is doing. Is it still rejecting there? You're trying to develop a feel for the market as you're watching the depth of market next to it, and you're also watching the order flow. So a lot of the time, once I've seen my opportunities on my charting platform here, my eyes move straight to my trading platform, and I'm then looking for execution. I've actually got an example of a trade sequence, just trading around 3 lots and then sort of scaling it out on a small trade sequence, which I'll show you later, which was actually taken some time when I was trading the ES at the end of last year. I think it was October or November or something, and it was early part of the day, but it was just a short sequence that just sort of shows you how you can read it on the dome and actually can see it happening in real time, and actually then trade around it as well, and then start actually managing a trade around that rejection and then the move actually happening. So that's going to be later on today, but don't move too small a time frame because it can become misleading. You do want to see this rejection occurring from a slightly bigger time frame, and for most of you, I would recommend you use around a 15-minute chart. That will save you mistiming your trades or getting in a little bit too early. Now, like I said, it's okay. Sometimes you're still going to get in too early. Sometimes you're going to get in before the market actually starts to top and you're looking for a top information. You're going to start to get in before the bottom is actually put in when the market starts to, looking for a bottoming formation. Okay, that's okay. We can deal with that with risk management and trade management. Okay, so you're not looking to become perfect with execution. You can't be. It's not possible. You can't be 100% perfect when it comes to execution. You can get better at execution, and you can time your trades a lot better, and you might become 80% perfect, but you will never be 100% perfect. Okay? So that's important to understand. You deal with that through trade management. Trade execution is just a part of the picture. That's just getting in. Okay? So these are just some of the things you can use to start getting into a trade or get into a trade. So is there any questions about bottoming and topping tails? I mean, like I said, it's just pretty much this. Bottoming, topping tails. Topping tails, bottoming tails. You can see it pretty much on most major reversal. Topping tails, bottoming tails. Topping tails up here. It's a very simple concept, not too complicated. Bottoming tails here again, what do we see? Reversal again. Now, of course, you're not going to just trade that. You're going to look for some confirmation that you're actually seeing the rejection there. But the first thing you're going to see when price tests an area is the rejection occurring on price, because that's probably what you're going to be looking at. So that will just be, for me, a heads up, okay, move to order flow. I'm now starting to see some rejection where I think it might happen. Yes, absolutely. That's what I just... Yeah, so just to reiterate, I use order flow to confirm rejection from these tails. Okay? That's what I do. Now, there's a number of ways you can see these tails being put in. You can actually visualize these being put in when you're looking at your depth of market. You can visualize these being put in when you're reading the footprints. You actually do see them on the footprints, but some of you might not know how to see that on the footprints. It is actually there. It's a sign of rejection. So remember, what we're looking for here is we anticipate an area of rejection. If we're looking at the low volume areas from yesterday, the profiling concepts, okay? Where are we anticipating rejection? I mean, this is a good example here. You know, you got an area of value, you're trading around that. You know, you would have this area of value, say, from this day. Let's just say none of this has happened. Here, this has not happened, this has not happened. Okay? But, you know, you've got this area of value to do business in going into this day on the 13th of February. Okay? Market gets below value, what do you start looking at? Okay? So, let's say this has not happened. You can already come into the market and say, okay, where's my high volume areas, low volume areas? This is what I do every day in the trade room. Okay, I've got a low volume area down here. Got a low volume area just here. Okay, volume drops off. Got a low volume area here. Got some low volume areas above value right here. So the volume drops off in these areas, right? So now you've got your areas for doing business. The market goes into the next day. You start saying to yourself, okay, once it gets into this area, I'm going to be watching for price rejection. What do you start seeing here? Price rejection. Okay, then you can say to yourself, okay, that's my opportunity. Now I can start reading the order flow. What you don't want to do is read order flow throughout the whole day, because you don't need to. You only need to look at order flow when it gets to the point where you want to do business, right? You only want to look at order flow when you get to the area where you want to do business. So you get to the area where you want to do business. You've anticipated we might find some buyers down here. Then you start watching what price is doing. When price moves lower, does it start to pop up? Does it start to pop up? Do the bids start getting cut off? Do the sellers that are hitting into the bid start getting cut off? Do the buyers' bids start absorbing the sellers? Now we start moving on to the order flow, right? So you can see that. Firstly, though, your heads up is okay. Am I even seeing any sign of possible rejection there? The market's getting down here. Am I seeing any sign of rejection? Okay, you don't have to be too eager to get in. Okay, you start seeing a bit of rejection there. You know, you can start working in a long. You might even get along here. Trades from 39s to 41s, you get your first, second target. You know, you may not necessarily get flat there. You may hold on to it and buy some more as it comes into 38s, 37s, which I'll talk about later. Okay, or you might get taken out of break even and then get back in again, 38, 37s. There we are, it's holding again. Get some bottoming tails. Let me confirm that with order flow. Now, these are 30-minute bars. It's not just moving, is it? The market's testing this area and then rejecting, testing again, rejecting, testing again, rejecting. Right? Then we come into the resistance areas on the other side. We can have that already in place before the market even gets there. What happens? Topping tail. Then you can say, okay, I've got a topping tail there. Let me move to the order flow. Let me start executing around these topping tails, looking for price rejection and some aggressive selling. Can you guys see how that might work? Remember, this is just a heads up. It's not pull the trigger. This is good enough as a heads up and say, okay, we've got some rejection occurring where I think it might occur. Does that make sense? Everybody following me so far? So remember, it's really important to understand that first you're trying to anticipate where rejection may occur. Then you're looking for some signs of rejections to start to occur. You're not going to be the first one to cause rejection to occur. Okay? Most of us are not trading big enough to make the market move off an area of rejection. Remember, what we're trying to do here is anticipate where longer time frame players are going to do business, institutional activity is going to take place and cause rejection. So we're anticipating where that rejection might occur, and then we're looking at the charts to see whether rejection is starting to occur. And we can simply read price to see that. Firstly, we can see price rejection occurring by just seeing topping tails, bottoming tails. Nothing more, nothing less. You don't need more than that. You could then say to yourself, okay, I've got a heads up. There's some rejection occurring where I think it might occur. I already know where this market may go to because I understand the auction market theory principle. So if I'm getting long here, what's the target? You're pretty much trading into the value high. If you're getting short up here at 45, 44s, what's your target? You're shorting into the 38s, right? That's your target. So you're trading from the value at low to the value at high. Value at high to the value at low, right? Most of the time, that's what you're going to be doing. That's what I recommend each and every single one of you focus on doing until you get really good at it. You don't need to complicate it. Trade one simple, effective concept continuously until you get really good at executing it and managing it well. Okay? A lot of it comes down to managing the trade well. The concept has to be very simple, but it needs to make sense. It needs to be effective, and it needs to be in line with the auction market theory principles. Therefore, it's self-fulfilling. Okay, it will happen more often than not because it fulfills the purpose of the marketplace. If you are trading to fulfill the purpose of the marketplace and you're trading around what fulfills the purpose of the marketplace, coming back to the trade facilitation process, then you have huge odds in your favor purely from doing business from that standpoint anyway. Then if you can anticipate where market participants may do business ahead of time and anticipate and understand where the market may go from and to, which is all going back to step one, now you're moving into, okay, where am I going to start to get into the trade? Well, the first thing is, okay, am I starting to see what I think may happen? This is very much a forward-looking approach. You've got to see what's going to happen before it happens, and then when it starts to happen in the moment, you've got to pick it up. You've got to say, okay, what I feel and think and believe should happen and may happen is about to start happening. And the first sign of that is when you start to see price going into that area and we start seeing some rejection. We start seeing it struggling to get through those resistance areas that you've predefined. You start see it struggling to get through those support areas that you've predefined. Now, what you don't do, and this is important, is just put some orders out there and just hope and pray that it holds. Now, that might work for some of you. It just doesn't sit well with me, and it's not the way that I trade. Because just because you have some support areas here and some resistance areas above value, and there is a good chance that it will hold, doesn't mean it necessarily will. Now, you do want to put the odds in your favor in the moment. You are trading what's happening in the moment. So, although it is true that most of the time these areas will hold, to put the edge in your favor even more, and that's what trading is all about. It's about putting the edge in your favor and gaining an edge in the moment. The way to establish that, firstly, is to start seeing what you feel may happen start to happen. Just the first signs of it. And the first signs of rejection occurring is rejection occurring, right? So we anticipate an area of rejection. We anticipate rejection to occur. The simplest way to read rejection is price rejection. Topping tails, bottoming tails. Okay? Very simple concept. Don't need to complicate it. Now we start to find some bottoming tails here. And then you can look for the market to go back to 44s, 45s. I'm not sure what happens next, but okay, there we are. This is an example where we continue to drop lower. Okay, so this is where trade execution, you might still get something out of that, but this is where the trade management stuff that I'm going to discuss will really help you out, and then reading the order flow to get out of those trades, because not every trade is going to work. Just because you anticipate buyers here, first time around it works. This short works. The next time around we get into this area, this rejection area blasts through. Okay? Now, how do you understand if you get into that trade, how do you know when to get out? That's also an important thing to know. So remember, you're not getting into the trades thinking that it's going to work 100% of the time. Any one of these trades that you get into has a good chance, but okay, it could fail. And this is where you have to know how to deal with it and and know what to look for when it comes to order flow. And also when it comes to trade management, you need to know how to deal with it and minimize your risk. in those situations as well. Okay, so, but coming back to the simple concept of actually looking for heads up of getting in, price rejection. It's a nice heads up. It's a reason to start looking at the order flow. And that's what you're looking for. You're looking at it, you're looking to find a reason to start looking at the order flow. Because you're not going to be sitting there reading the order flow every tick of the day. Okay, unless you're looking to scalp. And you can scalp the depth of market and you can scalp the footprint. I'm not talking about that right now. I will discuss some ways you can scalp when I bring up the domes, the depth of market, and discuss the trading ladder and what's happening. You know, you can trade around that. And a lot of prop traders do that. And some of you guys that are prop traders may be trading that way right now, just trading the depth of market. But, you know, you got to have an area of interest. You got to have an area for doing business. So, you know, yesterday was all about establishing that. Then you've got to at least understand what you need to look for when you get there. So the first thing we'll look for is price rejection. Okay, topping tails, bottoming tails, very simple stuff. Okay, now we can take this a step further and start looking at Heikin Ashi bars as well. Now, Heikin Ashi bars, you can again put these on any time frame. Now, you do need Market Data Professional to use these. They are optional, but I've been using them a long time. And actually, they do provide good confirmation, and I actually can see the swings more clearly. So, you know, you look at a candlestick chart, you can see what's going on, but it's a little bit more whippy choppy. You know, you can see the push up, push down, push up, push down. But it's a little bit more whippy choppy. Now, you can put this on a 2-minute chart, 5-minute chart, etc. Now, with Heikin Ashi bars, I personally like Renko charts. And I use these more so to get a feel from the market from a shorter term perspective and read trade location for my entries from a structural perspective. And what I mean by this is, now we'll use this as an example, 0.5 Renko, that's pretty much what I use on the S&P most days. So let's go back to some of the concept we discussed yesterday. Of unfit highs, unfit lows, retail prices. Now, we will see this also from a micro perspective. You guys may notice that we actually saw this market balance a little bit before we push lower. So, again, we're going back to the concepts of balance and imbalance. Here's balance. There's imbalance. So this happens not only on a longer time frame perspective, it happens short term, intraday. We will constantly see balance and imbalance. Balance and imbalance. Okay, so this is commonly known as the stages or the cycles of the market. Okay, we will quite often see the market go from what we call a stage 1 into a stage 2, imbalance, then stage 3, balance, and then into a stage 4, which is imbalance lower. So the market normally moves in cycles, stage 1, stage 2, stage 3, stage 4, and then back to stage 1. And that's basically the rotational nature of the markets. Okay, it does that. On multiple time frames, multiple perspectives. Again, that is just trading around the auction market theory principles. Premium up here, wholesale down here, retail in the middle. Now, we also see this happening within these ranges. So within each one of these micro ranges, we can also see, what do we have? Fair value price in the middle. Okay, I'm just going to label these. Fair value, you can see that? Fair value price in the middle. And a lot of the time in the trading room, I'll cover this and go back to basics. I'll say, look, okay, right now, where the market is trading around right now, what is the fairest price? What is the unfair lows right now? What is the unfair highs? Okay. So you can look at that and say, okay, we've got a unfair lower down here, fair price from eyeballing the chart. And you don't have to draw a profile around it. You just need to put it in your mind's eye and understand from watching price action from this micro perspective that there is also an unfair low, retail price and an unfair high. The market will trade around that. Now, the reason you want to know that is from a trade execution perspective. You ideally want to execute at an unfair high, even on a micro perspective. So when you are looking to pull the trigger, you should be saying to yourself, I want to get an entry with trade location at an unfair high for a short. And on a long, you want to aim at an entry from a micro perspective at an unfair low. So, we can use this example. Let's say we're looking to get long at these unfair lows. We can then say to ourselves, I want to get long. This now may be missed. Let's say these two swings have been put in. Okay, but when we come back into this area, we can say to ourselves, from looking at this was an unfair low. That's where the buyers got cut off. So I want to focus on executing in this area. So that's where I want to read order flow and look for an entry. So this is fine-tuning trade location. So from a bigger perspective, let's assume we already know we want to buy down here. Forget about the VWAP and everything else in the background. Just understand the basic concept here. Then you can say to yourself, okay, you might miss this entry. You might say to yourself, okay, but I don't want to buy it up here. So this is not a place for me to buy because the sellers are probably going to come in here. And more than likely, from a risk management perspective, if I execute my entry right up here, the sellers are going to come in and I'm going to have to take some heat on the trade. So to put the odds in your favor of the market moving in your direction as soon as you get in, it's important to understand trade location and balance and imbalance from a micro perspective. Again, this is why I said yesterday, if you don't understand the basic concepts, even when it comes to order flow, you would struggle if you don't understand the basic concepts of balance and imbalance, unfair highs, fair value prices, and unfair lows. So this is why, because when it comes to trade execution, you still need to understand how you are executing on a micro level around this structure, around the context of balance and imbalance. Does everybody see that? So you could say to yourself, this is not a place to execute right now in this range. So you'll wait patiently to get unfair lows. You'll wait for it to advertise at unfair lows. You want to aim at executing in that area. And this is now homing in. When you're stalking a trade, this is what I call when you're stalking a trade. You know where you want to do business, you're stalking a trade. You're saying to yourself, I'm going to focus on executing a long position at unfair lows, not only from a longer time frame perspective, but also from a shorter time frame perspective. So ideally, in a nutshell, what you want to do, you want to focus on buying at unfair lows from a longer time frame perspective within a wider context. But at the same time, when it comes to trade location, from an execution perspective, you also want to execute at the unfair low for the micro range right now. Okay, now when it comes to shorting, you want to short at an unfair high from a longer time frame perspective, but you want to focus on executing close to that unfair high also on the micro range perspective. Does that make sense, guys? Very important. Very, very important. I can't stress how important it is. It's probably one of the most important things to understand about execution. Where are you going to execute in terms of trade location? Quite often, trade location is more important than where you execute in terms of structure, rather than what you see on the order flow. Sometimes you will execute more aggressively, selling into buying and buying into selling. And the only way you will have the confidence to do that is if you understand the micro perspective structure. Okay, and I want to talk about that a little bit later when we talk about the footprints and also when we show you the depth of market. Okay, and understand how you might be looking to do that and what you need to be reading when you're looking to do that. So, just have a look at this example here. We've got unfair highs, longer time frame perspective, 120-minute chart. We're anticipating, coming into Monday, we're pretty much in this area right now. We're anticipating a move off this area. So what's a good place for execution in terms of getting into a trade for timing? Well, we can say to ourselves, we've got a bit of a range here. Unfair high up here, fair price in the middle, unfair lows down here. So we can come into this and say to ourselves, logically, it makes sense for us to get short somewhere up in this range. So this is like targeting the area or the prices for execution that make the most sense to get get involved in. So now you can see from a longer time frame perspective, we're expecting this push down. Okay, so you can say to yourself, okay, I'm going for a move from 68s to 52s for the bigger move. Now, when you move down to the smaller time frame here, you can say to yourself, okay, I'm looking for trade location in this area. So I like the Heikin Ashi bars and the Renko time frame, or the periodicity, Renko periodicity, because it just makes it easier for me to see these swings. Okay, the Heikin Ashi bars basically is just a smoothed out candlestick. It's another form of Japanese candlestick analysis, but it's more smoothed out. It basically is the average. It's an average bar candlestick. It's forming a candlestick based upon the average of the last 3 bars. Okay. Now you can read up more on Heikin Ashi bars. I'm not going to go into them in too much detail because it's quite basic stuff, and I've covered it in some detail in a lot of seminars and webinars that you guys have probably been on anyway. So it's not important to know exactly how they are formulated and understand the mathematical calculation to build a Heikin Ashi bar. But here's a website that does a very good job of explaining it. So I won't waste time on explaining how candlesticks, Heikin Ashi candlesticks are formed. But if you are using Market Delta, it's important to understand that Heikin Ashi bars are not included as default. It's actually a custom indicator, and it is totally optional to use. I like to use it because I have a habit of using them, and I've used them for a number of years. And it just helps smooth out price action. Okay. So you can apply Heikin Ashi bars on any time frame or any periodicity. You can put it on a volume chart, a Renko chart, range bar chart. So that's not important. Okay. I personally like to use Renko bars. And Renko bars are just basically range bars. They are just range bars that are formulated from looking at breakouts from the prior bar. It's very much like the point of figure concept, point of figure charting concept. Okay, breakouts out of ranges. So basically a 5.5 Renko chart is basically a breakout out of a 2-tick range on the S&P. Okay, so that will happen quite often, but it's then further smoothed out by using the Heikin Ashi bars. Now, any of you guys that want these chart definitions, just drop me an email. I'll send them to you. So you can just import them into Market Delta, and you have all of the charts set up automatically like mine. Most of you guys already have set it up. But if you haven't, then just let me know. Now, these chart definitions will also work with Investor RT if you use them. The footprint concepts will not be applicable in Investor RT because it doesn't support the footprints. But everything else you can use in Investor RT. Now, if you are using a different charting platform, I recommend you shift to Market Delta or Investor RT. But if you are using a separate charting platform, most other charting platforms can support most of these tools that I've covered. So Heikin Ashi bars, for example, are included in NinjaTrader. A lot of people use NinjaTrader. Volume profiling concepts can be used in NinjaTrader. There are actually some third-party companies that support tools, volume profiling tools for NinjaTrader, and also provide the VWAP, also provide the market profiles. So if any of you guys are planning on using a different platform, most platforms now do support volume profiling, or most platforms are beginning to. CQG supports volume profiling and market profiling. TradeStation, I believe, even now supports volume profiling and market profile. Sierra Charts support volume profiling, market profiling, as well as the footprint information, the bid-ask information. And there are also tools and plugins that you can put into NinjaTrader to also set up footprints in the same way that we read them in Market Delta on NinjaTrader. So you can get it set up. I would recommend, for make it easier on yourself, easier for me as well, that you all use Market Delta if you want to use these concepts in the same tools. because most of the tools that I use are in Market Delta. But like I said, other software packages can support them, but I won't be able to support those packages. Okay, but I can point you in the right direction if you need some help. But I won't be able to help you get them set up because I don't use those other charting packages. But with Market Delta, I can help you set that up, and it's very simple. You just import my chart definitions. Okay, so Heikin Ashi bars are a custom indicator that I have added to my Market Delta, and it will only work with Market Delta Professional. It is completely optional, but if you do like to use them, you can use them. Okay, now Heikin Ashi bar is very simple the way you read them. Again, you'll see the topping tails, these rejections, okay, bottoming tails as you do on candlesticks. Not quite as pronounced as they are on normal candlesticks, okay? So that's why I do still like to use the normal candlesticks. What the Heikin Ashi bars are good for is confirmation, when the market actually starts to move. And that's normally how I like to read the Heikin Ashi bars. I don't use them so much for execution. I use them more so for confirmation and staying with the trade. Okay, so the Heikin Ashi bars you will see on my charts in the trading room, and you will see me using them, but I use them more so to just read price swings, and I read them more so for confirmation. Now, some of you might decide to be a little bit more conservative with your entries, and if you decide to be conservative with your entries and you decide not to use order flow, which again you don't have to use, there are a lot of traders that I've worked with and I'm continuing to work with on my mentorship programs that actually start off using the Heikin Ashi bars. And some of you guys actually found it, I know some of you guys are here right now, that actually found it more profitable for you to just get into the trades, because they are high probability trades anyway, using a simple execution concept like the Heikin Ashi bars. Now, how do you use it to execute? Well, it's very simple. Let's say you got a key level for doing business here, for selling. Soon as you get a red bar with a wick towards the downside, okay, it's a little bit different to the normal candlesticks. With Heikin Ashi bars, you need to see a wick towards downside and no wick on the upside. That's a strong selling bar, okay? That's a strong down bar, okay? More aggressively, you can use a red bar for execution. So you could execute, for example, on this first red bar we see right here, okay? More conservatively, you can wait for a bar like this, where we have a wick towards the downside, but no wick on the upside, as you can see. Okay, and we have that again right here. Okay, and that's okay. When you get in, you put a protective stop above the highs, or if you don't use a stop, that's fine. Okay, but that's a good enough reason to get in. It's a high probability setup. You're expecting some rejection here. The thing is, with execution, you don't have to be that perfect. You don't have to be that perfect. There is nothing wrong with using a Heikin Ashi bar and selling here at 66 halves or 67s. It's not a huge edge over somebody that shorted at, say, 67 halves up here. It's not going to make or break you. Yes, on some trades it might pay off to get in, that 1 point earlier or a few ticks earlier. But if you're looking for a bigger move from 68s down to 52s here, or at least potentially into 68s down to, say, 58s, about potentially a 10-point move, is it really going to make a lot of difference whether you get in here at 67s or 66s or 68s? It's not going to make a huge difference. Right? So, at some point, some of you guys will see that getting in late is not necessarily a bad thing. Sometimes it pays off to wait for that extra confirmation. And if anybody finds themselves in a situation where they have this ability to get into trades too early a lot of the time, and they find that becomes a bit of a habit, and they're constantly trying to short the highs and the market just keeps moving higher, then your order flow timing and reading of price rejection needs some more work. Sometimes the easiest way to get around that is actually become a little bit more conservative with your entry, and that's where you can use the Heikin Ashi bars. Close of a Heikin Ashi bar, get in. Okay, you want to get long down here off this support area. Close of a Heikin Ashi bar, get in. Yes, you're going to get in a little bit later, but if you're looking for that bigger move, it doesn't really matter. You can even use it for scalping, but it's ideally an execution method that you might want to consider if you're a little bit more conservative. And there's nothing wrong with it. It works. I will sometimes get in, even on more volatile markets, with Heikin Ashi bar confirmation. For example, on something like the Nasdaq. A lot of the time when I'm trading the Nasdaq, I'll wait for it to move before I get in. When I'm trading the DAX, I will wait for that market to move a bit in my direction before I even decide to start getting in. I'll wait for the buyers to start lifting the offers when I start to get long in a more volatile market. I will wait for sellers to start hitting the bids and price start to move lower before I start to get short in a more volatile market. Now, more liquid markets that are less volatile, like the E-mini S&P, the Euro stocks, the Bund. Bund is a little bit more volatile these days, but there are days where it's pretty well tamed, and it has a nice 20 to 30 tick range, which you can be a little bit more aggressive in. But it's down to you guys as traders to define when you need to be more aggressive and more conservative. There is no right or wrong. And some of you guys are going to have the personality to naturally be a little bit more aggressive with your entries, being a little bit more earlier with your entries, or looking to pick tops a little bit more aggressively, or pick bottoms a little bit more aggressively. Some of you are going to be more aligned with being a bit more conservative. And that's all a personality thing. Okay, so now with mentorship students, I often figure out their personality with them and find out what works best for them. But we figure that out during the process by actually trying one method and then another. You don't know what's right for you until you try it. The way that I execute trades may not necessarily be exactly the same right way for you. You might need to be a little bit more conservative. You might even prefer to be a little bit more aggressive in certain situations. But at the end of the day, this is an art form, and only you will know what is right for you when you've understood the basics and you begin to apply them. Okay, so Giles got a question here. What is your preferred Renko setting for the Euro stocks and the Bund? The Euro stocks, I use a 2 Renko, a 2-tick 2-point Renko chart. And for the Bund, what is it set at? It's it's actually set up as a 2.5 tick Renko chart. Now, if you have the new version of Market Delta, you can define that in ticks, so you can define it as a 2.5 Renko chart. But if you have the older version of Market Delta, you'll have to put it in. Actually, I'll load it up. Let's have a look. Just give me a second. I'll just load up the Bund charts. I have a separate database set up for the Bunds. And separate instances. So some of you guys might also want to get that set up. It helps because your databases don't get too heavy for some markets. Now, I have all of my interest rate derivatives, the Bund, the Bobble, the 10-year notes and 30-year bonds set up in this layout in a separate instance of Market Delta, which uses a separate database. So I've got basically this is what I use to trade the interest rate derivatives. Here's a trade that I took actually on Friday on the Bunds. Now here's an example where I scoured in, but I added into the position as it moved in my direction. I shorted 44s, then 40s, and I got an average entry price 40s, 42s. Now, it didn't really move a hell of a lot that day, but still came off pretty well. I ended up covering at 34s, 27s. So notice I covered at the VWAP, covered at the unfit lows, then I covered at the VWAP again as it really just consolidated. And we had a number coming out, put my stop above the highs here, and the number came out and we just popped down. But this happened really quickly. If you look at it on a time-based chart, you probably won't see the swing up and down. That's why I like the Renko bars, because it normally shows you this movement, which often can be a little bit difficult to read when it happens really quickly on a time-based chart. So you don't see these bars, and that's one of the other reasons why I like the Renko bars or range bars, and also use the Heikin Ashi bars. Okay, because it just sort of shows me those swings that you probably won't see otherwise. Then I ended up covering here at 21s. Then, as you can see, we got below value, held that support area 1272 extension, which I covered yesterday. Swing low to high was taken here. That was the area where I used as a target. So this is a good example here where I used it as a target. But if I wasn't short, that would be in the area where I would be looking to get long. And you can see what happens. Where does it get to on the other side of value? Like I said, the Fibonacci stuff works really well. Again, I'm just using recent examples. This happens all of the time. Swing high to low. What happened? We hit the 1272 extension on the other side. As you can see here, this yellow line. Popped right back down again. hit the VWAP, bang on, and then push back up again. It's magic the way it works. It's not magic, it's just normal. But it seems like magic at times because it happens so often. It's almost like having a crystal ball. Right, so yeah, the Bund here, as you can see, it's set up on a 0.025 Renko chart, which is basically a 2.5 tick Renko chart. Now, in really volatile phases, or when the market picks up volatility, I'll often shift that to a 3 tick Renko, 0.03 Renko. Okay. Okay, so well, actually, I set them up on my longer time frame chart. So here's a 60-minute chart, and I do all my analysis, and I pick my levels on my 60-minute chart, like so. So here's the value area that I'm trading around on the 60-minute chart, and that's why I was short in that area that day. So I'm trading around this, and you can see a big look at the spikes and rejection. I mean, topping towers, reversal, bottoming towers, reversal, topping towers, reversal, bottoming tower, reversal, topping towers, topping towers. Look at this big spike here, topping tower. Okay, we had some topping towers in the morning. Okay, when we started to confirm. Sometimes you'll be getting short before those topping towers start to show up on the bigger time frames, or you'll be getting long before those bottoming towers show up on the longer time frame. But once they show up and you're still in that trade, you get that extra surge of confidence and belief in that trade, and that's what happens to me. I'll say to myself, okay, I'm anticipating that this 30-minute bracket is going to close with some rejection here. But I'm going to start buying into it. I'm going to start selling into it before it closes. And once that bar or that bracket closes, I know that it's confirmed that rejection. Then I have higher confidence that this move is actually going to play off. Okay? So sometimes, you know, we'll anticipate these things happening as and when these bars are still forming. So I manually add these levels here on these charts. Now, the automated way is to, you know, tick this box, put the peaks and valleys on. I personally prefer to add these levels on manually. I use these buttons, put a sell zone on there, etc. Now, I have these levels already set up. There's actually a way in Market Delta to attach these levels to what we call VHash variables. Okay, so you can see here I have a VHash4 sell zone variable set up. Now, I don't want to start going into the ins and outs of setting that up, but basically, and what it means, but I have a video that shows you how to set that up. All the trading room members have access to it. I will happily send you a link to set that up. And actually, if you give me a moment, I'll post up the link to that. Actually, Giles, it'd be easier if you... I know you sent me a reminder to send you the webinar on getting started and business planning. Maybe if somebody can drop me an email, send me reminders to drop you guys all the link to the video that shows you how to set up the levels and then link them across different charts. So that way you don't have to do analysis and pick your levels on every chart. Now, if I move this level here on this time frame, on the 60-minute chart, it's automatically linked to the other charts. So you'll notice it will drop. So when I drop this down, notice what happens on this chart. It moves down. So it automatically moves. I do all of my analysis on the longer time frame chart, and my levels are automatically put on my smaller time frame charts and my footprints. So, you know, it saves you the hassle and the extra work of having to put the levels on your other time frames. There's actually a document which Michael, who is here, kindly put together for me to set up the different Market Delta instances. And it's actually on the Ultra-ST members website, but I'll be happy to send that out as well. Let me just quickly make a note of that. And getting started webinar. Levels, video, and 3 MD instances. Okay, so just setting up some reminders. I'll email all this stuff out, but actually on the Ultra-ST members website you'll find that document anyway under the document section, somewhere there. But I'll send it all out, so you know, it saves you the hassle of looking for it. I'll just send this all out once we're finished later on today. Okay, So, yeah, just to answer your question and reiterate there, Giles, these levels are automatically put on all the other charts, and there is a way to set it up. Investor RT will be able to do it in the same way, so the video will apply to Investor RT and Market Delta. Now, if you are using other software, they may have ways of doing that, but I'm not quite sure. Okay? You may have to do it manually. Okay, so yeah, Heikin Ashi bars, just to confirm there, make sure everybody understood this. It's very simple. You know, a green bar is a bullish bar, a red bar is a negative selling bar. Go to that link that I posted up there. It gives you a little bit more information on Heikin Ashi bars. They're very simple, easy to read, and give you nice confirmation. And they're very good for execution if you want to simplify execution. Execution really doesn't have to be that complicated. Like I said, you can never get perfect execution. You can get closer to better entries, and you can reduce your risk by getting a better entry. But, you know, getting in early doesn't necessarily mean it's a better entry. Getting in at a higher price doesn't necessarily mean it's a better price. For sure. You know, getting in lower doesn't necessarily mean it's a better price for long. Okay? It does if it confirms, if it starts to move off that. But, you know, if you're selling at higher prices and the market keeps moving higher, it's not necessarily a better price, right? You know, if you're selling at lower price and the market just keeps moving lower, you know, then it's not necessarily the best place. You know, it's not necessarily a better price. So, you know, being early or being first or getting there right at the lows or right at the highs is not necessarily essential. It's not essential at all. So, what you have to do when it comes to timing and execution is understand where are you getting in structurally. So, you know, if I've understood this is the unfair high of this range and this is the unfair low from a micro perspective and this is the fairest price, as long as I'm getting in somewhere in this area, it doesn't matter. Now, I can use order flow to get in. I can use the Heikin Ashi bars to get in there. I can use a candlestick to get in. I can use the bar chart to get in. I can use the dome to get in. As long as I've got in somewhere here and I have good trade location in reference to the market structure, that's more important than getting in too early or too late. Does that make sense, guys? So I often hear traders saying, okay, I don't want to use the Heikin Ashi bar because it just seems like I'm chasing the move. Well, you're not chasing the move here. If you're getting in here or even here, if, you know, you have a very good chance of at least getting down to here. It doesn't, you know, it doesn't make any sense. You're not chasing. Getting in late is a misconception. Getting in early is a misconception. You know, what you believe to be early and late is purely in your head. It's a belief. You know, what you consider to be late may be early for somebody else. What you consider to be early may be late for somebody else. Right? So it's purely what you believe to be early and late is all in your head. What you have to put it into the context of is market structure. This is why I said, you know, you have to understand trade location when it comes to the micro perspective and apply everything that we understood yesterday. This is why I said it's really important that you understood the basics, concepts. Can you guys see how the auction market 3 principles apply when it comes to execution as well on a micro perspective? Absolutely, right? Good. So, you know, if I'm trying to set up here, potentially for a move down to here, does it really matter to me if I get in at 68, 67s, or 66s? Not really. Doesn't really matter. You know, I could say to myself, this is my range for doing business. And that's what I'll do in the room. I'll highlight it exactly in this way. I'll say, okay, I'm looking to get short and get an entry or build an entry somewhere in this area. Not an exact price. I don't care if it's to the tick or anything. Just because I've got a level up here doesn't mean I have to short right at that level. What I have to establish is, when I'm getting into this trade, is there still opportunity in this opportunity? Is there still opportunity? Is there potential for movement in this opportunity when I get in? So this is where, James, you asked the question yesterday. I shorted these areas. And, you know, you quite rightly pointed out that it is in the VWAP. Okay, but, you know, what we have to remember here is that this move started here, and this is off the number. This happened in minutes, and the only reason why we can see this move even happening here is because I've got the Heikin Ashi bars. Now, if you notice on a minute-based chart, you couldn't really see that move. This is, if you look at a 15-minute chart, you can't really see that happen. You know, what you see on the minute-based chart is 50-minute chart, bang, bang. You know, it just looks like noise. What somebody would just call, okay, just noise. Nothing is going on in here, you know. Somebody just looks at that and then say, okay, we had some rejection up here. But I can see with the Heikin Ashi bars, we actually pushed up. And these bars will sometimes on a number be put in a number of seconds. Okay, well, we ended up right about here somewhere. Okay, ahead of the open. Okay, this is, you know, at 1:30 p.m. GMT. Okay, but that happened and it was untradeable. But remember, I am trading, as I said yesterday, around this area of perceived value. So when I see this rejection up here, I am shorting this area and this area in reference to a move that is potentially going to go to here. So for me, when I look at that and ask myself, is that a good place to get in? I say to myself, yes, because this is still the unfair highs of this range, which I am actually trading. It may not necessarily be above the VWAP first standing deviation high, and most of the trades are, but I'm not trading around that context. Okay? So it's okay for me to take this because I am still in the unfair high range up here, and I'm looking potentially for a move here. But it didn't happen. You know, I still ended up getting my first target on each one of these, but, you know, it didn't give me the bigger move. But, you know, I anticipated it. At least I had a partial move off it. Okay. Now, later on in the day, you know, we can see that this is a little bit more evident that we have this kind of rotational range. Again, it's pretty sideways. It's a bit of a channel, I suppose you can see there. But, you know, you can say to yourself, you can eyeball this chart and everybody can sit there and say, okay, that's pretty much, if I'm seeing this right now, is the range. You know, we've had a pretty much a swing high to low here. This is pretty much 100% retracement. You know, that's pretty much the unfair high range. So we can anticipate that's the unfair highs. And then we can say this is coming into the unfair lows of this range. Okay, somewhere in this area. It doesn't have to be exact. I'm just eyeballing it. You don't necessarily have to draw these on your chart. Now, I don't normally put these on the chart. Okay? The only time I put this on the chart is if I want to make it clear to the audience in the trading room what I am perceiving as a current range right now and what I am perceiving to be the unfair highs and the unfair lows. Now, it's important to understand what you consider to be the unfair highs and the unfair lows and the fair value price may not necessarily be the same as somebody else. But if we all apply the same concepts, most of the time we're all going to be thinking alike. Okay, we're going to be thinking in a similar way. We're going to be establishing the same ideas and establishing the same areas for doing business. The reason being because we all think in the same way. We do business in the same way. If we understand the basic concepts and apply what we all understand collectively, and we start to apply that, we will all end up doing something very similar, but it doesn't have to be exactly the same. Okay, so do apply the basic concepts, and you know, if you're applying them well, you will end up doing business well. You will end up finding the right places to do business, and you will find good trade location. But you know, don't turn it into a science. It is more of an art form. There is no exact way to do this. There is no right or wrong way to do this. Long as you can say to yourself, it makes sense that this might be an unfair high. It makes sense that this might be an unfair low. It makes sense that this is the middle of the range. This is probably what's a fair price area. That's all you need to do, you know. That's all you need to do. So, just a few ideas there from using price action and understanding trade location. The reason why it's all important to, very important to understand this stuff is because when you are going to execute off the order flow, it's all within this context. Does that make sense, guys? Hopefully that makes sense. Right. So, we're going to have a little break now. So let's have a 5-minute break, guys. And then we'll start moving on to the depth of market, time and sales, and the market data footprints. And I'll discuss the concepts of reading order flow, how the auction's orders flow, and how to read market participants' behaviors by getting into the very micro level analysis of order flow. So have a 5-minute break, guys. Be back shortly. Right. Let's get started again, guys. So just to recap, just been covering the use of price action, bar charts, candlesticks, and Heikin Ashi bars for heads up for execution. And also reading price action on a more micro perspective for understanding the auction market theory principles for trade execution and trade location. Now, when it comes to actually putting the trigger, we've got to have some confidence, or we've got to gain some confidence that the market is about to do, or is setting up to do, what we have already anticipated. So, please understand that the order flow is step 4 of the old twisted game plan. It comes into play when you have already highlighted an opportunity. Well, firstly, you've understood the market structure. You've understood what kind of phase we are in, balance, imbalance. You've understood what the market is trying to do. Then you've highlighted the opportunity. You found a key area for doing business around. Then you've moved to step 3. You've identified that this trade has enough potential for good reward when you compare it to the amount of risk that may be involved, and therefore you want to get into the trade. So now that you want to get into the trade, you got to pull the trigger, and in a timely manner, and like I said, with risk management in mind. So you are looking for not perfect execution, but you are looking for a good entry. A good entry based upon what you understand and perceive to be unfair and fair right now, from a micro perspective, but in reference to the context of the bigger time frame. So we will discuss the depth of market, which is commonly known as the DOM or the DOM, which is commonly what you see on your trading platform. Now, I would assume most of you guys are familiar with what the depth of market is, sometimes also known as a price ladder. Then we look at the time and sales, and then we look at the market data footprints. So, firstly, we've got to understand how the market participants do business. And again, the auction market theory principles very much apply. First, you have to understand this is a zero-sum game. There is actually no such thing as more buying or more selling. So, when we say there's more buying or more selling, it really doesn't make sense. However, you do have differences in behavior of the buying and the selling. And it's that behavior that drives the market. And when I'm talking about behavior, I'm talking about which market participants, the buyers and the sellers, are trading with a sense of urgency. Meaning that they are trying to get into the market right now, and it looks like they want to get in with a sense of urgency. A lot of the time when there's a sense of urgency, market participants will be more aggressive and they will accept that worst price. So a lot of the time they will go in at market, they will hit the bid or lift the offer. Now I do it myself. If I don't get filled on a limit order, which is essentially what I normally would like to do, okay, I will have to lift the offer. because the market will not give you the opportunity to get filled on the bid. If I want to get short, rather than going at the asking price and put an offer in at the asking price with a limit order, okay, I'll do that. Now, if it doesn't look like I'm going to get filled, I'll go in and place an order at the bid. So I'll hit into the bid. That, in essence, is what you do when you go in with a market order. Now, if any of you guys have seen a trading platform with a buy market or buy sell at market order, that's what it does. It hits into the bid or lifts the offer. Or if you just see a buy and sell button, it will go in at market. Now, you can join the bid or you can join the offer, and that's basically going in with a limit order. So, it's a behavior that drives the market, and I want you to keep that in your mind and remember that it's the behavior that is going to move the market, not more buying or more selling. Okay? Now, the thing with order flow is to recognize that the auction market 3 principles do apply. The market will move up and will continue to move up until the demand gets cut off, or the buying stops lifting the offer, or the buying can no longer lift offers at higher prices. And similarly, with the other side, the market will move lower, and it will continue to move lower until it is met by the opposite force, and the buyer's bids start to cut off the sellers that are hitting the bid, and then we actually start to see the buyers lifting the offer. Okay, so the market actually moves off the imbalances or the trade initiation at sequentially higher or lower prices. So what we will commonly see is the market will be moving lower, it'll be hitting into the bids, hitting into the bids, hitting into the bids, and it will be moving sequentially lower. So the reason why the market is moving lower is because it's able to take out the bids as it moves lower. So that's what we call sequentially taking out the bids. Okay, that's the order flow imbalance occurring. The supply is exceeding the demand. There is that imbalance. Okay, remember yesterday I covered something like this. Supply exceeds demand. Okay, it is great. It's a greater force. Okay, it doesn't mean more selling. Okay, it doesn't mean more buying. It just means that there is more aggressive selling. That is, more sellers are aggressively hitting the bid and taking out the bids. That's usually what will move the market lower. Okay, I say usually because there are some cases when it doesn't. Okay, but most of the time that's what you will see. The market will move higher when buyers are lifting the offers at sequentially higher prices, and they are able to keep doing that. Now, that will only keep moving higher until they either stop lifting the higher prices, or it's met by the opposite force, and the sellers are strong enough to cut off that buying. Well, it's actually a bit of both. Okay? So we need to be able to read that. We need to read that as and when it's happening. So it's very much like the auction market 3 principles. The market moves up, until the buying imbalance is cut off. The market moves down until the selling imbalance is cut off. Again, from a micro perspective, it's balance. The market will trade between the bid. So it's very much seeing the bid and the ask as balance. Okay? And then imbalance occurs as it moves away from the current bid and ask price. So you got the bid, you got the ask. When we are trading those two prices, the inside bid and ask, we have what we call balance. Okay? It's pretty much the same concept as the market moving sideways. Okay? It trades up, trades down, trades up, trades down on a micro perspective. And then what happens? We all of a sudden start lifting the offers and the market goes up, keeps lifting the offers. That's an imbalance. So from a very micro perspective, the auction market 3 principles still apply. Okay? So we've got the bid, again, the ask. There's always a bid-ask price. There is always two prices being traded right now. Okay? The last trade will either take place on the ask or will either take place on the bid. The market will fluctuate between the bid and the ask. Trading the bid, trading the ask. Trading the bid, trading the ask. Trading the bid, trading the ask. And then all of a sudden we trade the ask lift all the offers on the asking price, and then we'll trade the ask again, lift all the offers on the asking price, and that's when we see imbalance. Okay? So it's when we start lifting the offers at the asking prices at sequentially higher prices, the imbalance upside occurs. On the other side, if we start taking out the bids and then keep taking out the bids at lower prices, then the market moves lower. Does that make sense, guys? Basic concept, but can you guys see how that is auction market theory? Balance and imbalance. Balance and imbalance. Good. Now, this is a typical trading platform. We're going to look at the depth of market. Okay, this would all become clearer if it's not already too clear for you. So, now, how can we read these imbalances? So we know what we're looking for. We're looking for the market trading the bid and the ask, and then we're looking to establish when an imbalance is occurring, when a buying imbalance is occurring, and when a selling imbalance is occurring. Firstly, you have to remember that trading is a zero-sum game. Trading is a zero-sum game. For every seller, there is a buyer. For every buyer, there is a seller. When a buyer lifts the offer, they lift a seller's offer. They cannot physically lift. Technically, they cannot lift an offer until there is a seller's offer there. It's like a buyer that wants to hit. It's like a seller that wants to hit into the bid. You cannot hit into the bid unless there are some bids to hit into. So for every seller that hits the bid, there's a buyer that buys on the bid. Okay, for every buyer that lifts on the offer, there's a seller that sells on the offer. Does that make sense? So it's a zero-sum game. For every buyer, there's a seller. For every seller, there's a buyer. Now, it's very simple stuff, but people forget that. People forget that it's a zero-sum game. And again, just to reiterate, what actually causes the market to move up and down is not more buying or selling. It's buyers continuing to lift the offers at sequentially higher prices, and it's the sellers continue to hit the bids at sequentially lower prices. That's what moves the market. That's when the market will move directionally. So, a trading platform, this is a snapshot of my trading platform. I use Trading Technologies Xtrader, but it doesn't matter what trading platform you use. This is pretty much the industry standard for prop traders, and probably the same for most institutions as well. But I can't speak for them, but I do know from a prop trading environment that nearly every trader uses Trading Technologies Xtrader. It's the industry standard. Okay, there are other platforms, and if anything else, traders will use CQG. Okay, now we prop traders, we don't have access to all of the retail trading platforms. Okay, for example, there may be a way to use NinjaTrader in some way, but my prop firm doesn't offer NinjaTrader. I can use Trading Technologies Xtrader, and there's a number of other platforms. There's an in-house platform, and there's a choice of about 7 or 8 platforms. But the main platform that most traders use is Trading Technologies Xtrader. Okay, so this is what you're looking at right now. This is what I trade with. So it's a very simple setup. What you see here is the amount of movement we've had on the day, up or down, the amount of volume that's traded that day, this amount of that's actually open in the trade right now, or in this situation, 0. These are just, you can change these to be whatever you want. Basically, these are just buttons you use to trade with, and apply the quantities. It's a default quantity field. This is the quantity that I will trade with, in and out. This is to put in a stop limit, stop market, OCO order, so order cancels order, go in at market, delete all, etc. So I'm not going to do a trading platform overview in terms of what buttons and what. What's more important here is the information we see here. This is the volume that we will label as pre-trade. Okay, this is pre-trade demand. It's orders that are sitting in the market as limit orders, but not yet traded. These are offers here, which are pre-trade supply. The reason why they're pre-trade, because the market hasn't traded them yet. So they are offers, and some of them may be real and some of them may not be. Okay, So do not assume that all of this is real buying or real buyers willing to buy. Do not assume that this is real sellers and they are all willing to sell at those quantities. Okay? A lot of this is electronically manipulated by high frequency trading systems. And now going back 5 or 6 years or so, trading the depth of market was a lot easier, and it was a lot easier to read and trade with. Okay, even back to when I started to trade as a prop trader, it was a lot more easier to read. That's in 2005. Okay, and now over the last 3 or 4 years, especially over the last 2 or 3 years, I would say, we've seen increased manipulation of the resting bids and offers. Doesn't necessarily mean you still can't trade using this information. You can. What you don't want to do is apply too much focus on the outside offers that are very far away from the market. What you do want to play more interest to is what's trading and what's offering on the inside bids and asks more so. Now, it's just 2 or 3 ticks up and down here. The main focus on the trading platform is this: what's happening here and here. Okay, this sometimes is useful if you're looking out for spoofing activity. And I've done an order flow scalping webinar for Trading Room members, which again I send out to you guys if anybody's interested in seeing that. But a lot of the concepts that I cover in there, spoofing and trading off the spoofing, is more applicable to more volatile markets, and some markets it's more easier to pick out and easier to trade with. Like crude oil, it's quite evident. I'm not sure if it is now because I don't trade crude oil so much, or at all actually right now. But some markets are more thinner markets, so you can see the spoofing a little bit more evident because it really stands out. But now with the thicker, more liquid markets like the E-mini S&P, the Euro stocks, there's so much volume sitting out there, it's difficult to pick out when there's spoofing taking place most of the time. But if you really look in detail, you'll see it happening. But you do have to sit there and watch the dome like a hawk, okay? But it's not that important to see the spoofing. The most important thing you really want to take away from reading the dome, and spoofing is basically, if anybody's not familiar with spoofing is spoof orders. They are not real orders. They are pretending or making it look like there is demand there. They're making it look like there is some supply there or offers that want to do business, but really they don't. So somebody might, for example, start bidding at 69.5, put in 1,000 on the bid there, make it look like there's a big quantity, large quantity waiting to buy 69.5. But actually what they're trying to do is pop the market up because people will start to lean on that. They will start to lean on it, try to buy above it because they think it's real buying or real buyers looking to buy. And then what happens, the market does have a tendency to pop away from it, but it's usually just a couple of ticks or so. And then what happens is that trader is more than likely looking to get short. And we usually see this happening when we see some bids come in, like here, for example, we'll have lots of bids come in and then the market pops up and then all of a sudden you'll see offers start piling in as well, or you see sellers start hitting the bids. So, this could be a trader that's putting in some false bids, but they pop the market up, they get the higher prices, and then they start selling. And then as soon as the market comes back to where those bids were, they pull those bids. So the thing to watch out for is the bids being pulled and the offers being pulled. So if you're going to look for anything on the dome, watch for what's being traded, which I'll show you in the video clips that are coming up next. But also watch for what is being pulled. What is actually disappearing. Okay? Because let's say we've got all of these bids here right now, 1137, 1223. If all of a sudden that drops in quantity and we're seeing sellers hitting the bids, that means this quantity of bids are getting out of the way of the sellers that are starting to hit the bids. And that's what you want to see for a directional move lower. Okay? However, because of the increase in high frequency trading, you'll commonly see the market is trying to push lower and lots of bids coming in here and then all of a sudden disappearing. So it does make it a little bit more difficult to see right now, but it's still there and you can still see it happening, and I'll show you in the next couple of clips. So just to understand here right now, that firstly, these are all resting bids. There's a limit order. So if you put a limit order here and you join this bid at 1370, your limit order will show up there as a part of that quantity. If you put in an offer at 1370 quarter, your offer will show up there as a part of that quantity. Now, if you want to get short right now, you will have to hit 70s. The other option is to put in a limit order on the offer at 70 quarters and wait to see if somebody lifts your offer. Okay? Does anybody not understand how order flow works? I mean, that's the basics of how order flow works. That's the basics. Does anybody have any questions about that before I move on? Some of you might be new to this. I know a lot of you may not be, but some of you may be. So if you are very familiar with how the order flow works, from how we trade on the bid and the ask, that's all good. So I just want to know if anybody doesn't know. Okay, good. So I'll move on very quickly then. So everyone's well versed on that, right? So we were trading into these bids, and we will move lower if we keep taking out these bids. We will move higher if we keep taking out these offers. If we can't take out those offers, we won't move higher. If we can't take out these bids, we won't move lower. That's basically the order flow, very much simplified. Okay. Now this column here, this red bar here, you can see the 1 on there. This actually shows how much is actually traded on that bid since we've been trading it. It goes red when we downtick, and it goes green when we uptick. Okay, so that's how Trading Technologies Xtrader works, which is my trading platform. It doesn't necessarily work the same way on every trading platform, but every trading platform will have this. Every trading platform will have the bids, and it will have the offers, and in the middle you'll see the prices. Okay. Now Xtrader also has a volume profile, which I like to put on so I can see where acceptance and rejection is occurring on a micro level. Now I use this for execution. So, if I was looking to short in this area, what would be a good place for me to be getting short? Somewhere in this area, right? Somewhere in this range. That's where most of the buying seems to be getting cut off. So I can use this volume profiling information on a micro perspective to also help execute on my trading platform. All right. Now the numbers you see on the right hand side right up here, this is just the amount of volume, the amount of contracts that is traded at each price. So it's basically the volume at each price, but in a numeric format. Okay. So this histogram builds throughout the day, and it shows me where acceptance and rejection is occurring in on an intraday basis. Now again, most trading platforms will do that. Okay. Any questions about this particular slide? Because we're going to move on to a video clip where I'm going to talk you through the market trading through the bids and offers on the day. Okay, good. So now, if I share the video clip here, it's going to probably be a little bit slow on your end because it's going to be streaming. So the best thing for me to do here is I'm going to change the operation of this webinar slightly so that you guys can view the slides with me online. And I'm going to take you forward onto the video clips because there's a few video clips today. Okay, covering some of the live trading sequences. Right? So